desk. Well, joining us to explain is economist Andrew Busch. So we're going to need you to break this all down in layman's terms for us. Why did these independent traders decide to buy up mass amounts of GameStop shares? Explain shorting to us easily.
Yeah, sure. So shorting is when you borrow stock and then you sell it to somebody else and you hope that the stock goes down in price, right? So if you sold short a stock that was at $100, then if it went down to 80, you would buy those shares back at $80 and you'd pick up 20 bucks, right? But the problem is that you have limited downside and you have unlimited upside when you I'm sorry, the other way around. When you have unlimited downside when you sell a stock and it starts to go up. In other words, the stock can go up to whatever price it wants to go up, and you will lose that amount of money from where you sold it at. So that's basically the game that a very big hedge fund, Melvin, and a few others were engaged in. They had really big short positions. And so what's fascinating is this subreddit called Wall Street Bets garnered a bunch of people on there. They figured out who was shorting the stock, and they started buying aggressively, and it pushed the stock up significantly. Again, there's no fundamental reason per se that this stock should be where it's at, over $300 or $400, when it was $2 back in August of last year.
Right. So how has this disrupted the stock market? I mean, I also wanted to ask about RobinHood, the trading app where all of these deals were happening, how they've responded as well.
Yeah, so because of the volatility, RobinHood actually had to shut down trading in some of these shares, GameStop being one of them, AMC, another beaten down stock, another one, Naked Brands, that's another one that got beaten down. These were all bought and pushed higher. And the reason why they had to stop trading them is not because of any conspiracy theory. It has to do with the clearing and clearing these stocks through RobinHood itself. So there's a lot of money involved with it. I don't need to go into the details, but there were a lot of people that were incensed on RobinHood saying, oh my gosh, there's a conspiracy that they shut this down and we're not getting able to trade our stocks. So there's wild swings in the price of this stock. It was at $400, then it was at $300. And just to wrap this up in a nice bow, the problem with this overall is not maybe so much RobinHood, but it's really the question of how can one entity or one hedge fund create such a large short in the market that retail investors can find out about it and then go after them and push that stock up and create the turmoil. Right. That's the question that really regulators need to look at, and the SEC is starting to look into that.
Well, what does this tell us about how the stock market works as a whole, about how volatile the stock market truly is?
Yeah, it's really scary. This is what worries me. I used to work at a regulator, the CFTC. They regulated derivatives in the United States. And I will tell you that I spent a lot of time looking at market structure, like who were the players involved? How did things work? And when I look at this situation, it tells me that there is a problem here for the structure of the U.S. financial system in the sense of how stock trading is done, how people can garner such large short positions that make the entire system vulnerable. You can go back to 2018, the inverse fixed products. That's crazy time of what happened there. Very similar situation. So there's a structural problem with equities in the United States. Why does that matter for everybody? Because if there's a structural problem, then everyone should be worried about every equity that's out there because some bad things could happen.
Right? Be careful what you do on the stock market. Bottom line here. Thank you so much for joining us. We are out for a short